measuring these things, those two rates, the official cash rate and the 6-month term deposit rate, tended to move in lockstep. And you can see there right through until the beginning of 2009 they did. And then the Reserve Bank cut the official cash rate to 2.5%, a record low. Mums and dads revolted. They said, we're not going to take it anymore. We won't accept 2.5% as our term deposit rate. And the banks, at the same time, coincidentally, were struggling to get money on international markets. There's another reason they've been very aggressive lately in term deposits. That's because the Reserve Bank has told them to be. At the end of June, the Reserve Bank issued new prudential liquidity guidelines, which says to the banks, you must have 75% of your funding coming from long-term foreign debt, so not hot money, long-term foreign debt, or from mums and dads, local depositors. Currently, the New Zealand banking system is about 70% funded from those long-term sources and from local depositors. So the banks realise they've got a problem. If they're going to comply with the Reserve Bank's request, they're going to have to go out there and compete harder for term deposits. Of course, Kiwibank is out there as well, which is almost, completely funded from these term deposits. And so the banks have got down and dirty in a stoush for term deposits. That has opened up that gap between the red line and the blue line. That gap essentially is a loss for the banks. That's competing away their margin. So, international funding costs up by about 100 basis points, local funding costs up by about 150 basis points.
Those two numbers aren't added to the
No. I reckon, and the Reserve Bank will be better to give you a measure on this, but I reckon overall that has increased the bank funding costs by about 100 basis points.
But the international costs have come down this year, right?
Yes,
yeah.
But they're still, as I show in this chart here, they're down at around about 100 basis points. They were at 300. If the conditions present in September and again in March had continued, we'd be looking at that number of 100 basis points extra funding costs being more like 200. Luckily,
members will have a lot of questions about these issues because they do go to the heart of some of the matters that we're considering, but why don't we let you finish your presentation and then we'll jump in.
Now, so my argument to you is that net interest margins for the banks have actually fallen. So you heard before from FinSec and from others, no doubt, that bank profits are bounding ahead. They've been rising very sharply for a decade. That's true. They have doubled in the last decade. Bank profits have doubled in nominal terms in the last decade. In fact, they've grown faster than GDP. GDP is up about 75% in nominal terms since 1999. But bank profits have not increased more than the amount of lending they've done. So, bank lending has risen by 100% in the last decade. And what does this mean? This means, and this is a full breakdown and you'll see it in the submission, it shows what's happened to the net interest margin. When I say the net interest margin, this is the profits banks make from charging for lending against what they're paying for funding. So this has nothing to do with the fees they charge for credit cards or for dishonouring overdraft payments or clicking the ticket on various things that they do, or on cost reductions. This is all about the lending and the borrowing side.
So it's the straight wedge between money in, money out.
Yes, yes. And those net interest margins have fallen in the last year. You can see ANZ Nationals down about 20 basis points, BNZ about 5, ASB we think around about 15 basis points. That number is for June, the others are for September. Westpac down around about 15 basis points. So the profits banks make from borrowing and lending are down 15 basis points, even after they haven't passed on the OCR. Kiwibank is the only bank that has not seen a contraction in its margins. Now, what has this done to profit? Now, profit includes a bunch of other things, including bad debts, bad loans that they've had to write off. It includes a whole bunch of other things, lower costs, higher costs, whatever they are. ANZ National, its profit virtually halved in the last year. Its profit as a percentage of assets, so how much profit they're making out of their total assets, which is a truer measure of profitability. It's a bit like I make a margin of 3% on my retailing. This is the true measure of bank profitability overall, so it includes fees and that sort of thing. ANZ National down from 1.1% to 0.6%. BNZ came out yesterday and announced it made a loss of 183 million in the last 9 months. That's because of...
Just a point of clarification, it's not a loaded question, is that before or after provisioning for tax?
After provisioning for the tax. Yeah, but before provisioning for the tax, it was also down. ASB profits are down. Westpac profits down. In fact, significantly down, not just in nominal terms, but in net profit to asset terms. The only bank that has not seen a profit decline in the last year is Kiwibank.
Is that because their borrowing is in New Zealand?
Yes, exactly. They're not borrowing offshore.
They're about to start.
They're about to start, yes, because of the competition from the local banks. Exactly.
Competition to lose money.
Yes, that's right, and borrow more for New Zealand. The other reason is that Kiwibank was more able to pass on the official cash rate changes to their mums and dads, their customers. Of course, that's ended now as the competition's come in. And this contention that banks have been profiteering for a long, long time is wrong. This number shows what net interest margins for the major banks and for all banks have been doing since 2002-2003. The introduction of Kiwibank, intense competition for housing loans, and the move to a fixed rate mortgage market has pressured the banks to reduce their margins by about 50 basis points overall.
Jim wants to use this in his book.
Great. Yes. Yes. You can argue a good third to half of that is due to Kiwibank. And that has saved New Zealanders perhaps $1 billion in terms of what you could argue the banks might have made if it wasn't there. But my point here is that the banks have doubled their profits in the last 10 years because we doubled borrowing. So, what does this mean for the economy and what's happening now with bank lending, particularly since the beginning of calendar 2009? Our banks have continued lending heavily to the housing sector. In the last 9 months, they have added $3 billion in new lending to housing, up to $165 billion. Over that time, the interest rate for new first-home buyers dropped from 10.9% to 6.4%. So we saw a 450 basis point drop in floating mortgage rates. Over the same time, lending by banks to farmers has accelerated by $3.1 billion. In fact, the banks have lent almost as much to New Zealand's 50,000 farmers or so than they have to the whole of the New Zealand housing market in the last 9 months. But lending by banks to businesses has slumped $3 billion in the last 9 months. When the pressure came on, the banks reverted to type of being conservative and lending against property and land. And lending to people who had wages and salaries, who they could chase down into holes if they couldn't get the money back. Whereas lending to limited liability companies is, according to banks, risky, and they don't understand it. I was speaking to a CEO of one of the big 4 banks here a few weeks ago. He said he'd like to lend more to businesses, but his staff are not well trained enough to understand business risks. And when push comes to shove, banks crawl back into their conservative holes and lend to land and property. Again, this is the big theme I want to get across here. It's all about the distortions in the New Zealand economy which encourage investment in property